Welcome to this webinar. IR35 rule changes for the private sector, who's affected, the key risks and the implementation options. We'll give it a minute to allow everyone to connect, and in the meantime you'll see coming up on your screen a poll question we'd like to ask you to answer, please. Okay, how clear do you feel about HMRC's changes to IR35? Very clear, reasonably clear, or not at all clear? We'll leave that up for a minute, and that will give us an opportunity to gauge the level of understanding we start with and provide a target for our speakers. We'll check again at the end to see just how effective this session has been. You may have seen the earlier session that we did together, which introduced the subject and gave an overview of the rule changes. So if you'd like a copy of that recording, haven't still got one, simply let us know via the Q&A button. If you've got any questions as we go through this session, please send them via the Q&A button and we'll answer as many as possible as we can at the end. Okay, so, right, that's a good number of you have responded. So you can see, perhaps you can see the screen, very clear we have 4%. So perhaps you can give this this talk for us then. 73% who are reasonably clear and 24% of you not at all. Okay, so let's see how many of you we can move up the scale, and I think we're ready to go. Thanks, Amelia. We'll come back to that later. Welcome to today's webinar, brought to you by Harris & Clark Rickaby's, a top 100 law firm, and the Giant Group, a leading workforce management services company for the last 30 years. Our subject is IR35 rule changes for the private sector. Who is affected, the key risks and the implementation options. Not surprisingly, I think, given everything else that's going on, many have left IR35 to the new year to-do list. So the need to address it is now urgent. The changes come into effect for many on the 6th of April. This session is going to assume your knowledge of the principles as we seek to delve into some typical scenarios and practical options as you now do your implementation plan. And we've tried to anticipate as many of your questions as we can. The session is going to cover what the changes mean for end hirers, what they mean for agencies and fee payers, the key potential pitfalls and risks, and the main implementation options. Our keynote speakers today are from HCR, Sarah Woodall. Good afternoon, Sarah. Who's a tax barrister and head of tax. Sarah was a senior civil servant with HMRC and now works with intermediaries and individuals on a wide range of tax issues, from effective handling of HMRC inquiries to tax planning. From Giant, we have Dan Haslam, who is Group Sales Director, and his role includes helping clients to manage their contingent workforces compliantly and cost effectively, using a whole range of Giant services. Good afternoon, Dan. Dan is also a member of the board at the FCSA, the UK's leading membership body for umbrella companies, limited company accountants and CIS payroll providers. I'm David Hopkins, a workforce management consultant with Giant, and I'll be the chair for today. The format's going to be conversational. I'll put my own questions to Sarah and Dan in order to give us a full view from a legal and practical perspective, and we'll then turn to questions from you, the audience. We already have a number of great questions actually and anticipate more, so feel free to submit yours as we go through the formal session. We want to hear from you, and we've allowed 15 minutes at the end to cover as many as we can. If you've got any questions specific to your situation, you will of course be able to approach the speakers afterwards via the details we will give you. Finally, we are broadcasting from remotely today, so apologies in advance for any sound or technical issues. I think we're good at the moment, so let us begin. Sarah, good afternoon.
Hi,
if we start with the end hirer situation then, who qualifies for inclusion and when?
Well, the answer to the question revolves around medium and large size entities. All public sector hirers will be affected, and medium and large private sector hirers, and that can include some charities. And they've got to apply the rules where they meet 2 of 3 tests. The first test is if their turnover is greater than 10.2 million a year. The second is if their balance sheet is more than 5.1 million, and that's assets before deducting liabilities. And the third test is if they have greater than 50 employees. So if they meet 2 or more of those tests, then they must apply the rules. And compliance is required by the 6th of April following the filing deadline. It's important to note also where a company doesn't satisfy the tests, they may still need to apply them in the future. And in particular, from the 6th of April, after the end of the filing period for the second financial year, if they do then meet the test later for 2 consecutive years. And similarly, if a company ceases to be small for 2 consecutive years, then they need to go back and start applying the new rules.
And are there any exceptions, for instance, non-corporate entities?
Yes, indeed. So hirers that aren't companies, registered or unregistered or overseas companies, and aren't LLPs, only need to meet the 10.2 million annual turnover condition to be caught by the rules. So they're more likely to be caught than a corporate. And it's important really to watch out, because connected persons to turnover can also be taken into account. So it's not only necessary to look at your own turnover, but if you have a connected party, you will need to take their turnover into account as well. Where this simplified test is used, the rules apply from the 6th of April following the end of the year when the condition is met. So that 2 consecutive year requirement that I described previously doesn't apply as it does with corporate entities.
Okay, and one other area of interest that we know has been questioned is around joint ventures and group company qualifications. How do the rules apply to them?
Yeah, that's a good question. And we're getting lots of inquiries for clarification around all of this. It's important to remember that if you're a subsidiary, if your parent of the group is medium or large, subsidiaries also have to apply the rules. So they mustn't just look to themselves. They have to look at the parent of the group. And similarly, for joint ventures, a company is only going to be small and therefore exempt from the rules if the controlling entities are small. So it's necessary to look beyond the immediate company to the controlling entities and think, how large are they? And if they're medium or large, then you will need to apply the IR35 rules.
Okay, so if we know the end hirers who are affected, then what stages do they have to go through, and what are their obligations?
Okay, so if the conditions are met, the rules impose an obligation on the hirer, the end hirer, to make an assessment determination of the employment status of every worker that they engage through their intermediary and an agency. And determining employment status is not necessarily a straightforward thing to do. We'll talk perhaps a bit about that more later, but once they've made the determination of the status of those workers, they have then to communicate it. And they do that using a status determination statement, or an SDS. And the SDS has to be passed to the worker and the person or the organisation that the hirer contracts with. And it's got to provide the conclusion about the worker's status and also the reasons for coming to that conclusion. And the reason this is really important is that the responsibility for deducting the tax and the national insurance contribution remains the hirer's until the SDS procedure has been complied with. And a hirer can issue an SDS before the 6th of April 21. So we're seeing this is starting to happen already.
Yeah, sorry, do go on.
So it's important, if you don't want to have to pay that tax and be responsible for paying that tax, that you comply with the SDS procedure really carefully. And the law requires that end hirers have got to take reasonable care when making status determinations. And this is important because failure to take reasonable care will result in the tax and the NIC again becoming the hirer's responsibility. And in this context, reasonable care takes its ordinary meaning and much along the lines of acting in a way that would be expected of a reasonable person in their position. So this means what's reasonable will vary from case to case according to the position of the person making that assessment.
Okay, so we've gone through the process, we've created an SDS, we've taken reasonable care. What procedures does an end hirer have to have in place should that be disputed?
Well, this isn't straightforward either. Once the determination has been delivered, hirers have to have dispute procedures in place to deal with any disagreements that might arise from their determinations. And I would anticipate, as this is very new and whilst it's all bedding down, it is quite likely that in the first 6 to 12 months, many disputes may arise as workers become familiar with the new rules in addition to those seeking to implement them. So where a worker disagrees with the SDS, the assessment, the worker can make representations before they receive final payment for their services. And the hirer can then consider the reasons and decide to either maintain the determination and give reasons for maintaining it, or make a revised determination and provide a date from which the new determination applies.
That sounds like it could get to be a complicated to and fro. So what is the timetable with this, and what if it's not met, and what if there's no resolution?
Yeah, I mean, coming as it does, during this time of global pandemic, the timing is not ideal. And also, hirers only have 45 days of receiving the notification of disagreement to respond to it. As you probably are aware, many of our clients are flat out just trying to sustain business in the circumstances of pandemic. So 45 days to turn this stuff around, particularly if you're receiving many of these challenges, it is going to be difficult. It's an added and unfortunate pressure at the moment. And it's important to meet that deadline, because if it's not complied with, if they don't respond within the 45-day period, the workers' tax and NIC becomes the hirer's responsibility. So, this could get very expensive. We're already receiving inquiries, and it's important to be aware that if a hirer receives a representation before the 6th of April, the hirer is regarded or treated by the law as receiving those representations on the 6th of April 2021. So they will then have 45 days from the 6th of April to respond to it.
Yeah, okay. Right. So going back to assessments then, you talked about creating the SDSs. I think we're all aware of HMRC's own CEST tool, and that it's got some limitations. What issues are you seeing, and is it entirely safe to just use the CEST tool?
We are seeing some issues, and whether it's safe to use the CEST tool really depends on a person's circumstances or an organisation's circumstances. What I should say is there have been very significant improvements in HMRC's CEST tool over the last 18 months or so. It is far better than it was in the past, but we are seeing errors as a consequence of clients using the CEST tool. The reason for the errors that we've seen so far have included sometimes organisations just misinterpret the CEST questions. They don't quite understand them and misinterpret them, and therefore they get answers that are incorrect. And this seems to be particularly prevalent where perhaps hiring managers who may not have any experience of tax or really very much knowledge of employment status and the law, and indeed the significance of getting this right, use the system. so they don't have the necessary experience. Or alternatively, we're seeing cases where hiring managers aren't aware that the working practices of an engagement might have changed. You know, there may be a new contract, there may be a change in what's happening in practice. That means that the output from the CESS questions will not be right, and that's reflected by the hiring manager when they put the information into the CESS tool. So the output of the CESS tool will only be as good as the information that's put into it. But perhaps more worryingly than that, in many cases, CEST provides an undetermined outcome, and that's in particular in complex cases. It's helpful because you know that you don't have an answer from the HMRC system and therefore will need to get help. And in such cases, it's necessary often to look at case law and apply legal tests, and mistakes are being made in cases where organisations haven't got the right specialist advice. So it's necessary to think very carefully if you get an undetermined outcome using the CESS tool. And also, sort of the third point really, in a minority of cases, using the CESS tool is inappropriate because there are some specific employment status rules for a narrow range of specific roles. For example, some healthcare roles, there are some very specific rules. CESS won't give you the right outcome for those rules. So it's important to know what the role is and if there are some specific rules in relation to those roles, rather than relying on the CESS tool there.
Okay, yeah. Dan, good afternoon. Perhaps I can bring you in here to describe some of the operational and practical aspects of using CESS and to give us a view of some of the third-party products that are out there as an alternative.
Hi, David, and good afternoon, everybody. Yeah, well, I think as Sarah's just covered off there, the CESS tool is good, but it has its limitations. It is heavily criticised, but there has been improvements made. I suppose one of my observations with it is that it is quite a manual process if you're using CESS to get an output. By Contractor, it takes some time. You've got to keep going through the same questions. So I think where a client has relatively small populations of contractors, then yeah, probably CESS is a good place to start. But in the market, there are a number of other commercially available assessment tools, probably three or four well-known providers in the market offering those services. They would argue that they're a little bit more rounded in the decision-making, bringing into play mutuality of obligation and some other factors that are missing from CESS. But as Sarah pointed out, it doesn't matter which approach you take and which tool you use, it's only ever going to be as good as the information that's being put into it. One of the benefits, though, of these commercial tools that are available is the online technology that they use. So it's done online, collaborative between a hiring manager and a contractor. And at the end of it, they'll produce an SCS statement, which can then be fed and passed into the supply chain directly. So it kind of brings some automation into the process. So I think if you're a client who've got significant contractor numbers, 3 digits or more, particularly given where we are in the calendar at the moment and when this is coming into play, then perhaps if you're going to go down an assessment approach, then they would be a better option to look at rather than necessarily using CESS. They also tend to come out with a little bit more of a sort of red, amber, green approach on a spectrum as to where the risk is on IR35, whereas, as Sarah said, CESS is a bit binary. You're either in, you're out, or then you're in this no man's land of undecided. So you get a little bit more feedback from those tools to see what's catching people out, can we tweak working practices, etc. But I suppose it's also just at this point worth mentioning as well, again, given the timeframes, what we are seeing is a lot of clients at the moment neatly sidestepping this whole piece around SDS statements and whether or not they want to go through that process by actually making decisions just not to engage contractors via limited companies any longer. That has some knock-on impacts in terms of supply and costs, but many of the large corporates are actually making that decision because, as Sarah pointed out, it's very difficult to actually fully understand the whole piece on IR35, even using CESS or using a third party. So for some corporate clients in particular, they're just sidestepping, say, right, we won't engage with limited companies anymore, and that means that we don't have to go through that process. Whether or not that's a good strategy for resourcing and whether or not they'll retain talent as a result, we'll have to sort of wait and see.
Okay. Now, risk is at the heart of all of this. I think the shift in risk is one of the main things that everybody's trying to address. So in those terms then, what risks can arise if an assessment is found to be wrong, Sarah, and are there any potential issues with that?
Well, there's some very significant potential cost implications for getting an assessment wrong. You can become liable for the workers' pay as you earn an NIC, as we've described, but also penalties are potentially very high and can be 100% of the tax NIC that's been avoided. So the financial consequences of getting it wrong can be really very significant. Also, just getting a challenge from HMRC can be very difficult, not only in terms of potential financial exposure, because they can be very difficult and time consuming. In practice, HMRC is likely to honour a self-employed output from its CESS tool without further inquiry, particularly if they're satisfied that the information that's been put into the CESS tool is all right and is accurate. But is more likely that HMRC will challenge the outcome where the status has been arrived, at by another means or by some other different electronic system. And given the shortcomings of CESS that we all know about and have talked about, alternative methods of determination are often necessary. So this brings a heightened risk of challenge from HMRC, particularly initially where everyone's getting used to this new IR35 requirement, and having to defend your position can have very significant time and cost implications. And in 2021, that's something everybody really wants to minimize the risk of. We're all busy enough just trying to keep business going as usual. A further risk, I guess, is around employment claims. If you get workers deemed to be employees as a result of the IR35 determination, they may suddenly think, okay, well, if I'm deemed to be an employee, I'm going to make an employment law claim. It doesn't necessarily follow that these people are entitled to holiday pay, sick pay, and pension contributions, for example, but it is possible that some workers will get the wrong end of the stick and that employment law claims are going to flow from some of these changes. That's something we're going to be watching out for. Okay. And I guess the final thing to be aware of is, the general time considerations, the general time that this whole process is going to consume, just particularly whilst people are getting used to it. It may take a long time to complete the assessments. It can take time to get advice. It takes time, obviously, to communicate with workers and those other parties you've got to communicate with. And it's also going to take time just to, implement the changes in the round. So what my advice would be, please don't leave this to the last minute if you can possibly avoid it. Give yourself the time that you need to get this set up correctly in good time.
Okay. So I think that's a good look at the end hirer position then. Let's now look at the agency situation. Which ones are affected, under what circumstances will they become liable for tax and national insurance payments?
Okay, well, an agency is going to be affected if it supplies workers to any public sector client, to medium and large size private sector clients, and to other agencies that supply public sector clients or medium and large private sector clients. And this means that that agency will become liable for paying the tax in NIC if any of the following apply. So if the agency is the fee payer, not the fee payer, but receives the status determination from the hirer above and doesn't pass it on, or if it's the first agency in the chain and HMRC can't collect the outstanding tax or NIC from the parties below, they then can become liable for paying the tax themselves.
Yeah. Okay. Yep. Fine. Okay. Now, HMRC believe that a very high proportion of limited company contractors and their assignments are going to be deemed inside IR35 rules. So their remuneration arrangements are going to have to change. Dan, can you give us a quick tour through the payroll and employment options that are now going to be available?
Yeah, sure. I mean, there's a number of different options available. I suppose the first one would be a client may well consider taking on people on a permanent basis, or actually take them on as employees directly. It is highly unusual for me to see that in the market. Most clients are actually, especially after the year that we've had, actually trying to retain as much of an agile workforce as possible. So unlikely to want to take a contingent workforce and put them on their own books, but that is a possibility. Similarly, for recruitment agencies that are involved in the supply chain, again, they may offer PAYE as an offering to those contractors that are affected. But again, contractors, in our experience, are quite reluctant to want to go PAYE. They contract because they like the flexibility. You can argue it tax as well, but I don't think that's the fundamental reason for most. It's actually a lifestyle choice for them, the way that they want to work. So they want to still retain and be mobile, even if they are now deemed for tax purposes to be like an employee. So that brings into play a couple of different other payroll alternatives. Umbrella is probably the most well-known. So obviously, Giant are a well-known umbrella business. The FCSA that I'm a board member of is a trade association for umbrella companies, of which there are many reputable ones in the country. And I think 70% of our estimations would be 70% of contractors caught by IR35 probably going to find the way towards an umbrella company who will basically engage those workers and employ them. So they will have the employment rights to match the tax implications for themselves. So they get holiday pay, pension becomes a factor, statutory, maternity pay, etc., etc. And the umbrella company is responsible for deducting all those right levels of tax. PEO is also another potential option. I've spoken about that quite a few times. It stands for Professional Employment Organisation. Now, this is very similar to umbrella. So the PEO provider would employ the worker still. The only difference is a slight difference in how the taxes are calculated and the presentation of the figures. So just without going into too much technical detail, when you work for an umbrella business, if you're a contractor currently getting paid £500 a day to your limited company, when you work through an umbrella, the umbrella receives that £500. There are deductions taken, and that leaves you with a gross taxable pay figure. But often contractors get confused by that because they think, no, I was on £500 a day, so why is this figure different? What a PEO does is ensure that when the contractor is being onboarded, it tells them that rate of pay that they're on. So in my example, let's say that's £430 a day, and that's the figure that they accept. That's the figure that they see on a wage slip. And so it can be a lot more transparent from the beginning. And as Sarah mentioned, I think there's a battleground post IR35 around employment law, taxation, and that's starting to sort of become aligned around employment statuses. One of the key themes from the government is around transparency on pay rates, and workers actually understanding what is the real rate of pay that I'm on. So you may well see this PEO model take off. It's very dominant in the US, for example. And then the final option that you see in the market is something called a deemed model or a fee payer model. And that's where an outsourced provider can effectively make the deductions that are due under IR35 for tax, but then make a payment off to the contractor's existing PSE company. That's a service that we, amongst others, offer. Benefits there are the contractor continues to be paid through to their existing limited company, but all the taxes are being deducted correctly and paid off to HMRC. And if that fee payer is in the supply chain, then effectively they're taking the risk under IR35 rather than the client. So there are a number of contractors we see that are quite attracted to that. I'd say 10 to 15% still quite wedded to these limited companies, even though they're deemed inside. So I would always advise agencies or clients to make sure they've considered a variety of different options, because in the end, all roads lead to the same net take-home pay now in this new world. But contractors may want some choice as to which way you want to go.
And in implementing these, then, are there any likely cost implications with the different approaches? And are there risk versus cost considerations to take into account?
I think, well, from a cost perspective, all the ones that I've just talked through there, you could effectively be cost neutral to a client, because the way that they can be structured is such that the margins that are being deducted are taken from that original rate, in my example, that £500 a day figure. So you can construct it so it becomes no cost, no additional cost to a client. However, in practical terms, what we tend to see is alongside IR35 determinations, clients will also do another important assessment, which is how business critical these contractors are to the enterprise, often putting them into sort of buckets. So, bucket one is we can't afford to lose these guys, working on business critical projects for us. And what they'll do there, clients will potentially look at increasing the rates there to maybe offset some of these taxes that are now due. So yes, you can make it cost neutral if there is no money in the bank and margins are fine. But if you've got concerns around contractors and whether or not you can retain them going through this process, then one of the easy things to do is sort of pour a bit more money into the rate that offsets some of this tax that's due. But clearly that's a financial decision for each business to make. But we do see that frequently, perhaps 20% of clients' contractor populations getting a lift in pay just to at least cover some of these employment taxes, to show a bit of goodwill and just ensure that they retain their services.
Okay, and I think that covers a number of questions that have come in as you've been speaking around who's actually going to pay this, the employer's national insurance and the app levy and any other deductions. So yeah, it will vary, but we're seeing a large number who are going to have to carry that as contractors.
Well, there is a lot of confusion in the market around this, particularly contractors. You'll hear regularly citing, these are unlawful deductions being taken from my pay, without actually fully understanding the contractual chain and the obligations of everyone in the supply chain. But in the end, it all comes back to whatever that rate is that the client or hirer is paying down. The money's got to come from somewhere, and it'll effectively come from that. But the actual legal amount that is the contractor's money, for example, dependent on which model we're talking about, often contractors lose sight of that. And that's why I'm back to my point I made earlier around transparency in the supply chain and people understanding what's the real rate of pay that I'm on here. I think we, as well as I'm sure Sarah would welcome a lot more transparency in the supply chain, which is coming. There's things like KID documents which agencies have to produce to give this information, but it takes a bit of time for contractors to understand it. But the market's moving in the right direction, in my opinion.
Right, well, in the interest of trying to get as much time as we can for questions, we're going to have about 12 or 13 minutes. Thanks for your responses so far. Let's move to those questions now. But as we do, perhaps we could relaunch the poll question, please, and just see what's happened in the last half hour. Have we moved anybody anywhere?
This is when we get nervous, Sarah.
Yeah, I'll leave that up there for a couple of minutes, or a couple of seconds. Okay, well, I think you've done very well, guys, because basically what you've done is you've moved all of those who were not at all clear. They've moved to the very clear, because the reasonably clear has remained the same at exactly 73%, which is kind of interesting. I wonder if it's the same people. And then the not at all clear, as you can now see, is 4%. So more homework required for you guys. But the very clear is now 23%. So yeah, I think you've done well there. We've now got a complacent category. Well done. That's well played. Good. Okay, so let's move to some of your questions then. And the first one, a detailed one, I think, and one for you, Sarah. Can contractors caught in IR35 be paid at the same time as other employees? And as their terms and conditions are different, would we have to try and set up another pay run for this?
Oh, good question. Well, there's nothing in the rules that means they can't be paid at the same time as other employees, and there's nothing in the rules obliging you to set up another pay run. But sort of thinking about this from a practical implementation kind of perspective, IR35 might apply in certain cases, so that it's necessary to make deductions for some contractors and not for others. And for that reason, in practice, it may be helpful in some circumstances just to set up a separate pay run to make it easier to administer. The person best placed to advise is likely to be your accountant, who's most familiar with your particular circumstances. But potentially it could be helpful, but it's not mandatory. It's also worth noting that the rules oblige the person who makes the status determination to take reasonable care. And that, we've described this before, but it does mean keeping thorough records. So if you're making status determinations, do make sure that your administrative process is transparent, and that you keep the documents that you will need in the event HMRC start asking any questions, just to substantiate that what you've done was reasonable according to your circumstances.
Yeah.
Well, just to add into that then, Dave, I'd say what we tend to see in practical terms is most clients will outsource that part of the payroll that's not gross payments to contractors. So if they're outside IR35, it's business as usual, which is just an accounts payable process, receive an invoice, pay. That's easy. Where you've got workers who are then inside IR35, it may well be that's when a payroll intermediary is brought in and the client is effectively running a second payroll, but to that intermediary, and then the intermediary deals with the tax, the deductions and everything else downstream from there. But yeah, it'd be highly unusual for there to be any sort of time delay in workers being paid who are inside or outside. Most clients are looking for workers to receive their pay in exactly the same frequency. It may just well be coming through a third party or some form of outsourcing if a client's made that decision to do so. But one of the big things for a contractor would be, just because I'm inside IR35, shouldn't be seeing a delay in payroll as a result.
Okay, and are there any issues with paying a PSC after deductions have been made on a payroll?
Yeah, is that a question to me then? I'd
Yes.
say there's no issue at all. I talked about it earlier. You can do that quite happily. A client can do that directly without any third party support. It's just that it's sometimes very difficult for accounts payable systems to then have PAYE calculations brought in. That's not standard functionality for a lot of clients, but if you can get the calculations right, there is no reason why you can't do a deemed calculation for tax, which is deducting off the employer's costs, deducting PAYE, deducting employees' NI, and making a net payment to the person's business bank account or the PSE's business bank account. But you've got to be certain you're deducting the right levels of tax, otherwise you're accruing a liability there. So again, practically wise, you then tend to see clients outsourcing that to a third party who generally would indemnify them against those tax risks because they're a payroll business and they need to get the numbers right.
Yeah, okay. So one of the assessment elements is around substitution, and we've got a question here. It says, if they have more than one employee in the limited company that's providing the service and can send a substitute, does that constitute not being in the rules? Sarah?
Okay, well, if a contract has a substitution clause, or if substitution can happen in practice or a situation makes that necessary, it may indicate that it's reasonable to make a determination that you're outside of the rules. What I would say, however, is that the contract terms have got to be realistic. Just because something's in a contract doesn't mean that if it's unrealistic, HMRC will accept it. So the scope for substitution must be genuine and all the circumstances taken into account before that's put into the contract. There is a risk if you agree unrealistic terms, you could inadvertently be facilitating a corporate criminal offence. So if you have any particular concerns about a particular substitution or a series of substitutions, my advice would be to seek specialist advice. It's not a straightforward area, and in particular, focus on, is this realistic? Is this likely to be necessary, reasonable, and proportionate in the circumstances and reasonably likely to happen? I hope that helps.
Yeah, okay. Yep, good. Fine. Okay, and the next one then. Okay, I think we've covered the period of notice to contractors to respond to a status determinations, 45 days. Sarah, if a contractor is deemed inside IR35, who pays the employer's national insurance?
Do you want me to take that one, Sarah?
No, it's fine. If IR35 does apply, the obligation to make the deduction of income tax, NIC, is on the party who satisfies the requirements for being the fee payer, or receives the determination and does not pass it on. So it's a bit like playing rounders. If you receive it, pass it on, or the ball and the liability will rest with you. This means in most cases, it's the party who pays the contractor's intermediary. But it's worth reiterating that even if the party doesn't satisfy the fee payer requirements, they can still be responsible for the deductions if they receive the determination and not pass it on. So if the criteria for responsibility aren't satisfied, the responsibility moves to the next party above in the chain. And these criteria, they can also apply to agencies in certain situations. Does that match your understanding, Dan?
Yes, I think if the right levels of taxes aren't being deducted and the parties built further down the supply chain have failed to pay either because they've gone bust or they've disappeared or what have you, then you're absolutely right. That liability can ultimately move all the way back up to the hirer for that unpaid tax. So I think it really reinforces the importance of hirers understanding their supply chain and ensuring they understand who is in this supply chain, and that these businesses are financially secure, they've got good balance sheets, they are going to be in a position to get things right and make those payments. I think from a practical perspective, in terms of who picks up this employer's NI bill, what you often see in the market is basically once a determination's been made on someone going from outside to inside, there will be a new assignment rate that's set, and that new assignment rate will be lower to create some space in order for the fee payer to be able to pay off these taxes that are now due for things like employers' national insurance. So if I think through, how we process payments to people's limited companies who are caught, if we were receiving £500, if that was the old rate for the worker, we would agree a new assignment rate with the worker that takes into account the employer's NI, the apprenticeship levy, if the payroll turnover is more than 3 million, and the margin, and set a new assignment rate. And even where a client's doing that themselves directly, that's absolutely what should happen. End the existing assignment, start a new assignment with a new assignment rate, and it's those deductions from that point that needs to be calculated. Again, when you go through an umbrella model, that's really exactly what's happening through an umbrella calculation as well. Effectively, there's a new assignment rate being given to the worker, which is lower to create the room for this employer's NI. So contractors will get it wrong and they'll get confused. They'll think employer's NI is coming out of their existing rates, but actually if it's done properly, it should be effectively a new assignment rate agreed, which allows for that employer's NI to be deducted above it. And therefore you're not getting yourselves into any unlawful deduction conversations.
And perhaps one last one then, Dan, again to you in terms of the process, if you like, and the practical implementation of this. If hiring a contractor that operates through a PSC via a recruitment agency, would it be usual to place the contractual burden of carrying out the SDS on the agency?
No, it would be highly unusual and irrelevant because it's not the agency's responsibility to do that determination. It's absolutely the hirer, the person who is receiving the benefit of that service. So to ask an agency to conduct that SDS would imply that they are the person receiving the service, which wouldn't make sense. If it was a consultancy that was supplying that and there was some form of statement of work piece between a consultancy and a hirer, then absolutely maybe that consultancy would be deemed as the fee payer in that example. But where recruitment agencies are supplying, you cannot mandate down or push your liability or responsibilities as the hirer down the supply chain. HMRC will see through that straight away. It is your responsibility as the client to do those determinations. Yeah. I'm sure you'd agree with that, Sarah.
The law is very clear and it precisely what you say, yes.
Okay, good. Thank you. Right. You have been grilled. Thank you very much. That's all we have time for today. Many thanks to our speakers and to you all for your attention. I see you're all still with us, which is great. We trust it's been very worthwhile for you. We will be following up with a link to the recording of this session with an email containing a quick questionnaire to let us know how we've done. And as I said earlier, we'll include contact details for Sarah and Dan, should you wish to pick up specific questions with them, or indeed get more detail on some of the answers they've already given. So that's it from us. Thank you and goodbye. Thank you, Sarah. Thank you, Dan. Have a good day.